What is a VA loan? I love this loan, and if you're a veteran, it's probably the right loan for you, but if you have a down payment, it is a bit nuanced if it is the right product for you, so stick around, we'll unpack that for you as we get through this video. Welcome back, my name is Gavin Sessions with Loans Made Simple. If you are interested to learn about all things related to mortgages and home loans, you're in the right place. Subscribe to this channel, we post new content each week. If you're ready to get qualified for a home loan or get connected to a great real estate agent, scroll down to find our contact information in the description, or feel free to leave us a comment. We'll be down there on the regular getting answers to all those questions. So today we're answering the question, what is a VA loan and why you might want one? Honestly, I think the VA loan is one of the best programs available, and I'm excited to dig into the details. But before we get started, since we're talking about the VA loan, I thought it would be a perfect time to give a shout out and thank you to our veterans that have served, and specifically a couple of veterans in my immediate family. So my late grandfathers, Robert and Milt, both served in the Navy during World War II, and my brothers, Grady and Gregor, have both recently served in the Navy, so thanks to them. All right, let's get after it. Here are the topics we're going to cover in today's film. Number one is a brief overview of what the VA loan is. Number two is the eligibility criteria, a few key program features, as well as some limitations. Number three, you've probably heard of VA entitlement, so we're going to help you understand what VA entitlement is. Number four, we'll do a brief comparison with conventional loans. And then last but not least, we'll wrap up with some FAQs and get you answers to those questions. So what is a VA loan? Well, a VA loan is a mortgage that is guaranteed by the U.S. Department of Veterans Affairs. The VA loan is specifically designed to assist active duty members, veterans and their spouses, as well as surviving spouses of veterans. VA loans are utilized for the purchase or refinance of 1 to 4 unit owner-occupied residential properties. Key point there is you must occupy this as your primary residence. All right, let's jump into the next section, which is eligibility, some key features, and then a few limitations. So as we already mentioned, you must be an active duty member, a veteran, and or a surviving spouse of a veteran. So eligibility for the VA loan is determined by a document called the COE, which is the Certificate of Eligibility, and that document is pulled by your lender to determine your eligibility. Eligibility means the veteran meets the criteria for the length of service and the character of service for the VA loan. Should also note that eligible veterans still have to meet the credit and income requirements in order to qualify to purchase a home using a VA loan. So active duty members are eligible once they have 90 days of continuous service in active duty. Veterans become eligible after 24 months of continuous service. Guard members and reservists become eligible after 90 days of active duty service or 6 years of service in the selected reserve or the National Guard. All right, let's jump into some key features of the VA loan and what make it such a phenomenal product. Number one is certainly amazing. You don't have to have a down payment to buy a house using the VA loan. So VA loans do not require a down payment, which means you can finance up to 100% of the home's purchase price. This is a phenomenal benefit. Additionally, VA loans do not require mortgage insurance, and this is crucial. When you have less than a 20% down payment on a conventional mortgage, for example, you'll have PMI. On an FHA loan, you're always going to have some sort of mortgage insurance for the life of the loan, but with a VA loan, even with 0% down payment, you do not have monthly mortgage insurance. Phenomenal benefit. Now, there is a type of mortgage insurance on the VA loan, and it's called the funding fee, and we will get to that a little bit later. Another amazing benefit of VA loans is they allow for a higher debt-to-income ratio. So debt-to-income ratio is very simply the amount of monthly recurring debt divided by your gross monthly income. And that monthly recurring debt shows up on your credit report. So VA loans allow you to have a higher percentage, often greater than 50%. Whereas conventional loans, typically you're going to have a debt-to-income ratio maximum of 43 to 48%. FHA usually will max out in the low 50s, and VA can go even beyond that. Now, why that's important is it can open doors to folks that may not have as much income, right? So you might be a lower income individual, and the VA loan can help open the door for you to buy a home. Another benefit of VA loans is often they have very competitive interest rates, sometimes the lowest interest rates of any loan product out there. Yet another cool feature of the VA loan is there's no loan limit. Now, that being said, you do have to qualify still from a credit and income standpoint for any loan amount whatsoever, but there is not a fixed ceiling on the amount of money that you can borrow when you're using a VA loan. So technically speaking, if you wanted to buy a $2.5 million home with no down payment, so long as you qualified from a credit and income standpoint, and so long as you had full entitlement, and entitlement we'll talk about a little bit later, you technically could do that without bringing a down payment. Keep in mind that just because the VA does not set a maximum loan limit, that each lender will have some sort of maximum loan limit, and that will depend on your credit and income as well as just the programs they have available. So one more really cool feature of the VA loan is the 1% rule. The 1% rule is a guideline established by the VA regarding the maximum amount veterans can be charged for certain non-allowable fees. It can help limit your closing costs. This flat 1% covers the lender's cost associated with originating, processing, and underwriting the loan. If the lender is charging the 1% fee, then they're not allowed to tack on additional charges for things that the VA considers to be not allowable. So it should note that allowable fees are not included in the 1% rule and they can be charged to the borrower. So here's a quick list of those fees. So as we've discussed so far, the VA loan has some amazing features, but there are a few limitations that should be noted. So the first is the funding fee, and we mentioned that earlier. It's the VA loan's form of mortgage insurance. So the funding fee is basically an upfront mortgage insurance premium that is charged to the VA borrower at closing. So if and when a veteran defaults on their mortgage, the funding fee is what is paid to the lender to help offset some of that loss. Now, the funding fee can vary based on several different factors. The first is how many times the VA loan has been used. So the funding fee has a discount on the first use. So typically it's about 2.3% of the loan amount. So doing very simple math, if the loan amount was $100,000, the funding fee for first time use would be $2,300. But it should be noted that the funding fee can actually be reduced if the borrower was to bring in some sort of down payment. For subsequent uses of the VA loan, the funding fee still exists and it's actually a higher percentage. So if you've used the VA loan to buy your first house and then you've sold that house, you've had your entitlement restored, now you'd like to buy a replacement house, typically your funding fee is going to be between 3.3 and 3.6%. But just as in the first use, if you were to bring some sort of down payment, that funding fee can be reduced. So long story short, whether it's your first time use of the VA loan or subsequent use of the VA loan, bringing a down payment will help to reduce that funding fee. Now, let's briefly talk about how the funding fee is paid for. The cool thing is you can actually finance that into your loan amount. So going back to our very simple example of $100,000 of a loan amount and the first time use, so 2.3%. So instead of borrowing $100,000, you would actually borrow $102,300 to cover your funding fee. And then what you do is you pay for that funding fee over the life of the loan. The other option is you can actually pay for that funding fee out of pocket if you choose. So you could bring that 2.3% into the closing table. So to wrap up this section on funding fees, there are some folks who are actually exempt from having to pay the funding fee. And those are any veteran that is currently receiving VA disability. So that exemption will show up on the certificate of eligibility that is pulled by the lender. And not having to pay that funding fee is a very nice benefit to those that are eligible. So continuing on with limitations, let's talk about credit scores. So the VA technically does not set a floor minimum credit score to use your VA home loan benefit. However, you still need to have a credit score and you still have to qualify with whatever lender you're using from a credit and income standpoint. So typically, most lenders are going to require a minimum score of 580, but I would tell you it's very difficult to qualify for a home loan with a score that low. So just keep in mind, there is no minimum, but it doesn't mean you will qualify. So long story short, the higher the credit score, the more likely you will be to qualify for a home loan or specifically a VA home loan. Another limitation of the VA home loan is you can only use a VA loan to purchase or refinance a primary residence of 1 to 4 units that you're going to occupy. So if you have your eyes set on buying a second home, or if you want to buy an investment property, the VA loan is not the right product for you. Now, there are some circumstances where if you were to purchase a home and have it be your primary residence using a VA loan, you certainly are entitled to a life change after a reasonable period of time. So you could convert that home to a second home, or technically you could convert that home to an investment property. But again, after a reasonable period of time, you're going to sign an occupancy affidavit at closing that says you intend to occupy that home within 60 days of closing. So as long as that's your intention, the VA loan is probably a great product for you. If you're interested in purchasing a second home or an investment property, then certainly conventional is probably going to be the right loan product for you. All right, the last limitation we're going to talk about here is the VA appraisal. And the VA appraisal, kind of like the funding fee, nobody likes it. The VA appraisal may have a bit of a bad reputation, but I don't think that's warranted, and just want to take a minute or two to explain why. So appraisals very simply are an evaluation of the property's value relative to homes that have sold that are similar recently. They're going to take into account things like age, location, price point, all those things. And an appraiser's job is effectively to make sure that you are not paying more for the house than what the market believes it is worth. So appraisals are awesome and they are super important. But VA appraisals tend to have a bit of a bad reputation because not only are they looking to determine the property's value, but they're also going to call out any obvious deficiencies in the condition of the home. And a big but here is just about health and safety concerns. So things that a VA appraiser are going to call out and require that are repaired prior to closing would be things like broken windows, super large cracks in concrete that could create a tripping hazard, a missing heating source. If you look at the roof, maybe there's some shingles missing. If you're looking at the exterior paint, maybe the paint is peeling. Maybe there is a missing railing on a stairway, or maybe on the back deck it's elevated and there isn't a railing there. So anything that's an obvious health and safety concern, the appraiser is going to note that and require that it be repaired or corrected prior to the VA loan closing. So that is why VA appraisals can have a bit of a bad reputation, but honestly, most of the time VA appraisals come back in great shape, as is, without required repairs that again would need to be completed by the seller. Just want to pause the video for a quick moment and invite you to connect with us if you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below. All right, so moving on, let's talk about VA entitlement. So VA loan entitlement refers to the loan amount that the VA will guarantee for each borrower without requiring a down payment. For borrowers that have full entitlement, the VA will guarantee 25% of that loan amount without requiring a down payment. And as we already talked about, that there is no limit, right? So technically speaking, you can borrow as much money as your lender will allow you to borrow based on your credit and income qualification and based on their overlays. So let's say you have partial entitlement, meaning that your entitlement is not fully restored for one reason or another. You might have partial entitlement if you're still paying back an existing VA loan, or if you've repaid your VA loan but have yet to have your full entitlement restored, which should be a formality. Or maybe you defaulted on a previous VA loan that you had. In other words, you foreclosed and didn't pay that debt in full. So if your entitlement is reduced, the VA will only guarantee for you 25% of the county's conforming loan limit, less your entitlement that's already been used up. So it's kind of technical, but long story short, it is possible for you to purchase a new primary residence using a VA loan, even if you don't have full entitlement restored. So rather than take the time to show a specific example, it's probably best just to invite you to reach out with your specific questions. So scroll down, find our contact information, reach out to us. Let's go through your specific scenario and find out if you have partial entitlement or full entitlement, and if you're able to purchase a home using a VA loan. So let's jump into a brief comparison and we'll show you a table view of the VA loan compared to a conventional loan. All right, let's start with eligibility. So VA loans, as we've already talked about, the borrower must be a veteran or an active duty service member or the surviving spouse of a veteran. For a conventional loan, there are no special eligibility requirements. For a VA loan, the down payment required is 0. As we've talked about, that's one of the coolest features of the program. For a conventional loan, if you're buying a primary residence and it's a single unit property, the minimum down payment is 3%. But if you're buying a second home or an investment property, or if you're buying a 2, 3, or 4 unit property, that minimum down payment will actually increase. So somewhere between 3 and 20% will be your minimum. Jumping into mortgage insurance. So with VA loans, there is no monthly mortgage insurance. We did talk about that funding fee, which is the VA's version of mortgage insurance. For conventional loans, you will have PMI for any loan with less than a 20% down payment. Let's talk about interest rates. So typically with VA loans, you're going to find a slightly lower interest rate than you would on a conventional loan. Credit scores minimum requirement for a VA loan does not exist, but often we're going to see lenders require at least a 580 score. On a conventional mortgage, you will see a minimum credit score requirement of 620. Property type, we talked about this as well. So primary residence only for a VA loan. So you have to purchase a home that you intend to occupy. Whereas on a conventional loan, you can purchase a primary residence, a second home, or an investment property. And then kind of last but not least here, the program fees. So the VA loan does have a funding fee. We talked about that, whereas there are no funding fees or program fees specifically for a conventional loan. All right, so we opened the video by teasing how great the VA loan is and that it's likely the best loan for you if you are a qualified and eligible veteran, but there might be an instance where it may not be the best loan for you. So before we answer that question, let's get to these most frequently asked questions. There's 4 of them. So number 1 is, can I use my VA loan more than once? Number 2 is is the VA loan assumable? Number 3 is, I'm a surviving spouse. Am I eligible for a VA loan? And we probably already answered that. And number 4 is, can I have a co-borrower on my VA loan that is not my spouse and also not a veteran? All right, so answering that first frequently asked question, can I use my VA loan more than once? The answer is absolutely yes, and that will depend upon your remaining entitlement. So if you use your VA loan and you buy a home and occupy it as your primary residence and then sell that home and that loan is paid in full, you can certainly go and buy a new primary residence using full entitlement on your VA loan. Keep in mind the funding fee will increase for subsequent uses of your VA loan. All right, so the next frequently asked question is, are VA loans assumable? We've not talked about that yet, but the answer is yes. VA loans are assumable, and actually FHA loans are assumable. But let's focus on what assumption is. So assumption is a fantastic part of the VA loan if we're in a situation where market interest rates have increased since you purchased your home. So let's say you have a 3% interest rate on your existing VA loan and you're looking to sell that house, but the market interest rate today might be 6%. That's a very attractive interest rate for a buyer who then could qualify to take over your mortgage. Now, the trick is if your house is worth $500,000 and you only owe $300,000 on your existing VA loan and you'd like to offer an assumption, buyer can qualify to take over the $300,000 amount of your existing VA loan, but then they have to close the gap with other financing or other funds of their own in order to get to that $500,000 purchase price. So that can be tricky and can be a reason why assumption, frankly, isn't all that common. But nonetheless, great benefit and something that certainly should be talked about when it comes time to sell your home. But we should also mention that selling your home using the assumption benefit will not fully restore your entitlement until the original loan balance is paid in full, either by you or by the home buyer. So if the person buying your home is intending to keep your VA loan outstanding for a long period of time, then your entitlement will not be restored until that loan is paid in full. That would put us back to our section on entitlement where we talked about, can you use your VA loan when you only have partial entitlement? The answer is yes, but like I said, that is a bit of a complex calculation, so reach out to us and we will help you get that answered. Moving right along, next FAQ is, I'm a surviving spouse. Am I eligible to purchase a home using a VA loan? The answer is yes. Surviving spouses are eligible to use a VA loan to purchase a home so long as the veteran died as a result of service or their service-related disability. Eligibility criteria may vary, so it's super important to get connected to a local lender and have them pull a certificate of eligibility to determine if you're truly eligible or not. All right, last but not least, one that we get fairly often is, can I use a VA loan to purchase a home and have a co-borrower that is not my spouse and also not a veteran? The answer is yes. But the cool thing about a VA loan is the VA guarantees 25% of that loan to help offset the risk, right? And allows you not to bring in a down payment. If you have a co-borrower that's not your spouse and also not a veteran, they will need to bring in their own guarantee, which is 25% of the loan amount that is assigned to them. So in a 50-50 scenario, let's say it was a $200,000 loan amount, $100,000 potentially assigned to the veteran, no down payment required, $100,000 potentially assigned to the co-borrower that's not a veteran and not a spouse. They would need to bring in 25% of that amount, which in this case would be $25,000. Another thing to note is when there is a non-spouse, non-veteran co-borrower on a VA loan, the VA will typically require that that loan be sent to them for additional underwriting before that loan can be closed or funded. Now, we did talk at the top that there is a nuanced situation where a VA loan may not be the right product for you, and that would be specifically because you have a significant down payment. So having a substantial down payment can help offset other risks and can help make other loan programs such as conventional potentially be more attractive or the right product for you. So it's super important that you reach out to a lender and get your situation reviewed. We'll slice and dice it and figure out exactly which loan program is best for you based upon your scenario. And if you're someone who's looking to buy a home or get connected to a great real estate agent, like we said, scroll down, find our contact information and reach out, or leave us a comment. We'll be down there getting answers to all those questions. And we hope you found this video super helpful. We will see you on the next one.